Hi everyone, I am Muhammad Arsalan, an ACCA member and AA expert tutor. And today I will be walking you through the key concepts of going concern, its impact on the audit report, and most importantly, how this crucial concept is going to appear in the exams. Don't worry, I've come up with a super easy way of understanding the topic with the help of a mind mapping technique in an amazing manner. So by the end of this video, you would be looking at going concern issue like a pro. So let's move forward towards the session agenda. I have broken this topic into 4 key parts to help you master it. First of all, we'll dive into how the examiner tests this topic, what to expect on the exam day, and along with the surefire approach to handle these questions. Then we'll do a comprehensive recap covering everything from basic concepts to disclosure requirements. This will boost your knowledge base and confidence. Next, I've got a super easy mind map for you to navigate through the implications of going concern issues on the audit report, with some reports excerpts to cement your understanding. And finally, we'll attempt an illustration question together. And if you can crack that, you'll know you're ready for this topic. Well, guess what? The study, guys, is practically the exam itself, hidden in plain sight. The examiners don't pull questions out of thin air. Instead, they take what's in that guide, tweak it a bit, and boom, it's a question in your exams. The only thing that changes is the context. Instead of just asking about a concept, they wrap it in a real-world scenario and ask you to apply it in the backdrop of scenario-specific facts. So if you know the guide inside out, you're halfway there. Writing about the significance and importance of a concept can easily earn you 2 to 4 marks in a factual knowledge question. But here is where it gets trickier. If you want to tackle a more scenario-based question, especially in section B of the exam, it is not enough to just know the basics. You need to have a solid understanding of management's and the auditor's responsibilities, potential indicators of going concern risk, the review procedures, disclosure requirements, and the reporting implications. Without this deeper knowledge, passing that section will be almost difficult. So make sure you are prepared to apply these concepts. Chapter 31 of the ACCA Study Hub is your go-to resource for comprehensive notes on this topic. If you're looking for clarity, this is where you'll find it. But don't stop there. Take advantage of the technical articles, also available in the Study Hub. These articles are incredibly helpful for understanding how to apply the concepts in real world. They bridge the gap between theory and practice and are highly recommended to solidify your understanding. Make sure to check them out. So let's move forward towards the overview of the key concepts. Going concern is a fundamental assumption that helps an entity to prepare its financial statements. It is basically an accounting term that describes a business that is financially stable and is expected to continue operating in the near future, or as they say, the foreseeable future. Standard use the term foreseeable future to refer to a period of at least 12 months from the year-end date. This essentially means that the entity is up and running for at least the next 12 months, and there are no plans or the necessity to wind up its operations. Under the going concern basis of accounting, the general purpose financial statements are prepared using the historical cost method, based on the very assumption that the entity is a going concern and will continue its operations for the foreseeable future. And a very important point to remember is that according to the standards, entities must disclose the basis of accounting in the notes to the financial statements. So here is another key concept that you guys need to know as a must: material uncertainty. It refers towards such unpleasant conditions, business issues, or problems which cast doubt over an entity's ability to continue as a going concern. Let's try to understand the concept through a couple of examples. In example number one, we are going to look at a company that is experiencing severe liquidity issues, mainly due to poor business performance and losses. It has an upcoming $10 million loan repayment commitment in just 6 months. But the banks and the financial institutions are reluctant to provide new financing, fearing that the business may never be able to return back the loan. This situation creates a material uncertainty about whether the company can continue as a going concern or not. Let's go through another example where the business is facing a major loss of a key client. A tech company that massively depends for its existence on a government contract that almost contributes 50% of its annual revenue. And the government unexpectedly cancels the contract. This situation is another example of a scenario that creates material uncertainty about whether the company can survive without this major revenue stream or not. Finally, if management determines that material uncertainties do exist, it must disclose them in the notes to the financial statements. So this one is an interesting situation. Imagine you're driving and suddenly your car gets caught in rising floodwaters. At first, you'd hope the water will recede. But as the car starts sinking, you come to realize that this is it. No more road trips, no more honking at slow drivers. It is time to abandon the ship. Similarly, when management determines that the company has no way out and no rescue plan is in place, it must accept the reality. The business is sinking. In this case, the going concern assumption is no longer valid. Just like you wouldn't plan a long drive in a car that is basically underwater, the company cannot prepare financial statements assuming it will keep on operating. So what happens now? Basically, the financial statements switch gears to a different accounting basis. Think of it as towing the wreckage to shore and assessing the damage. Financial statements would now be prepared either using a breakup basis or the liquidity basis, focusing on how assets will now be sold off and the liabilities settled. So this is an area where most of the students are susceptible to get confused. So I decided to add it to my presentation deck. So basically, the auditor cannot automatically assume if an event or condition casts significant doubt over entity's ability to continue as a going concern. It is the management's responsibility, and let me repeat it once again for emphasis purposes. It is the management's responsibility to make this assessment by performing various analyses ranging from profitability to liquidity. Many students falsely believe that it is the auditor's responsibility. You must understand that auditors are there to evaluate and not to take over this crucial role. Their responsibility is only to review and evaluate management's assessment of the going concern. Auditor will achieve this by obtaining sufficient and appropriate audit evidence by performing review procedures. So knowing this stuff can easily get you 2 marks if it appears as a knowledge fact question on your exam day. Well, the main focus of the auditor at both the planning stage and during the execution of audit is to keep an eye on indications of significant doubts in order to conclude whether a material uncertainty exists or not. These indicators can broadly be categorized as the financial indicators, such as negative operating cash flows, operational indicators, for example, loss of a key employee without replacement, and legal and other indicators, for example, adverse legal judgments against the entity. I would highly advise you to go through section 31.2.2 of the ACCA Study Hub that gives a comprehensive list of these indications that provide compelling evidence of the material uncertainties. Here is a snip that I've taken from the Study Hub. But here's the catch, guys. The examiner isn't just going to ask you to list these out. Cramming won't help here. Instead, understanding these indicators will allow you to diagnose from an abundance of warning signals, giving in a scenario about whether a material uncertainty exists or not. Pause this video and take a close look at the list. They're all telltale signs. For example, having a net liability position, withdrawal of financial supports from bank, and loss of key employees. They are all points to a situation where the entity might no longer be a going concern. Mitigating factors. It is important to highlight here that the indicators we studied in the last slide are not conclusive. The management may have plans that perfectly counter or mitigate the significant doubts. For example, in a liquidity crunch, asset disposal to generate liquidity, equity injection, new bank loans, cost-cutting measures, or even seeking government grants and subsidies may perfectly counter the risk identified in the earlier slides. In case the mitigation factors satisfactorily resolve auditors' observations, then there should be no implications for the audit report. Finally, sometimes, even after considering management's plans, the auditors may, in their professional judgment, determine the situation as a close call scenario. So what is a close call scenario? It is when a company almost faces financial distress but somehow manages to avoid it. In such cases, the auditor may classify the issue as the most significant audit matter or key audit matter and include it in the audit report as a CAM paragraph. We'll discuss CAM in detail with an example later in this video. Now moving forward towards a very important area, which is implications on the audit report. So this is the mind map I was talking about earlier. This will provide you with a visual memory of the implications of the going concern issue on audit report and make the questions easy peasy to answer. So let's move forward. Let me zoom it a bit. So ISA 570 primarily identifies 3 main situations which has implications for the audit report. So the first situation is that the basis of preparation is appropriate and that financial statements are prepared on going concern basis. Situation number 2 is that the basis is not appropriate. And the last one is that the management is unwilling to make or extend going concern assessment. So as you can see, that these 3 situations form the basics of the implications, and all other scenarios are primarily the offshoots. So let's start with the first situation. In this situation, the basis is appropriate, and the financial statements are prepared on a going concern basis. The auditor would then move forward to see if a material uncertainty exists. And in case it doesn't, the auditor would once again move forward to see if the scenario is a close call scenario. And in case the auditor concludes that it is not, the auditor would move forward to issue an unmodified report and would also ensure that the accounting policy note to the financial statement states that they have been prepared on a going concern basis. So this is a clean report. And in case the auditor concludes that this is a close call scenario, which essentially means that significant doubts existed, but they were not material. And if this is the case, the auditor would move forward to issue an unmodified report. But this time, the auditor would also include a CAM paragraph. A CAM paragraph is a key audit matters paragraph. Let's see an excerpt as to how this CAM paragraph would look in the audit report. So there we go. In the CAM paragraph, the auditor needs to ensure that there are at least 3 ingredients available in the CAM paragraph as they have been identified by the relevant guidelines and the standards. The first one being that the CAM paragraph must cross-reference to the note in the financial statements and identify the areas which are determined to be the high risk or significant risk areas. So in this case, significant losses and liquidity challenges are those areas which are determined to be of significant risk. The ingredient number 2 is that the auditor needs to identify those areas where significant auditor judgment was required. And in this case, this happens to be the going concern area. And number 3, the last ingredient in the CAM paragraph is that the auditor needs to show that how this significant matter has impacted their audit. And in this case, the auditor has presented all those additional procedures that it needed to provide for as the matter was considered a significant matter. So these 3 ingredients are really important and would be able to fetch you handy marks. Let's move back. Let's start for another scenario. Once again, the basis is appropriate and the financial statements have been prepared on a going concern basis. But this time, the auditor has concluded that material uncertainty does exist. Once this is determined, the auditor would then move forward to conclude if the management or the entity has provided for an adequate disclosure in the financial statements, highlighting the material uncertainty. And in case this adequate disclosure is presented, the auditor would move forward to issue an unmodified opinion, but this time he is going to insert a material uncertainty regarding going concern section in the audit report, which would essentially draw attention to the disclosure in the financial statement. Let's see how this would look. So there are, once again, these basic ingredients that you need to ensure are present in this material uncertainty related to going concern section. So this section is immediately given after the basis for opinion paragraph. And the first ingredient it should mention is the note in the financial statement, which is highlighting the material uncertainty. The second part is that the note must indicate that a material uncertainty exists that may cast significant doubts on the company's ability to continue as a going concern. And the third ingredient is that our opinion is not modified in respect of this matter. So these three ingredients would ensure that you are being able to fetch all the marks available in this question. And in case the auditor concludes that after identification of a material uncertainty, the management of the company has either not disclosed or inadequately disclosed the fact in the financial statement, the auditor would move forward to provide for a modified report and express a qualified opinion or an adverse opinion. Remember, an adverse opinion would only be issued if the matter is pervasive enough to impact all the financial statements. Let's see how would this look. So in this example, the auditor has issued a qualified report. So let's see, in our opinion, except for the incomplete disclosure. So there is the except for qualified report. So this is the first ingredient that must be ensured in the opinion paragraph. Secondly, in the basis of the qualified opinion paragraph, as the report has been modified, you now need to provide for the grounds of modification. It is very important, and this is the reason the basis of qualified opinion paragraph exists. So let's see what he has discussed. As discussed in Note Y, the company's financing arrangements expire and the amounts outstanding are payable on March 2002. The company has been unable to conclude renegotiations or obtain replacement financing. This situation indicates that a material uncertainty exists that may cast significant doubt on the company's ability to continue as a going concern. Therefore, the financial statements do not adequately disclose the matter. So inadequate disclosure forms the basis for qualified opinion paragraphs, ground for modification. Now let's move forward to see how would an adverse opinion look like. So see, the auditor has mentioned that the accompanying financial statements do not present fairly the financial position of the company. This is an adverse opinion, and what immediately would follow is a basis for adverse opinion paragraph. And this, once again, as the opinion has been modified, would provide for the grounds for modification. So the ground here is that the financial statements do not adequately disclose this fact. So remember, whenever an examiner asks for such a report, you need to ensure that all the ingredients are present in the report. They carry significant marks. Now that we have already covered the entire situation one, let's move forward to see what situation two entails. So in situation number two, the basis is not appropriate. That means the entity is not a going concern. And then if an entity is not going concern, so the basis of preparation is not appropriate. But in this scenario, the entity has yet chosen to prepare the financial statements on going concern basis. So this is a very serious scenario where the standard strictly provides for the auditor to give a modified report and an adverse opinion. And this adverse opinion would be provided irrespective of the disclosure. This essentially means that no amount of disclosure can rectify this situation. And as the opinion has been modified, it is so necessary to provide for the grounds of modification in the basis for adverse opinion paragraph. And this time, the grounds of modification is an inappropriate basis. From situation number two, there is another offshoot scenario which says that the basis was not appropriate but either the management on its own accord or upon specific ask of the auditor has now chosen to prepare the financial statements on breakup basis or liquidation basis. The auditor would now move forward to see that if the financial statements have been prepared on breakup basis, which is pretty much all right, and he concurs to it, the next step would be to see if this fact is adequately disclosed in the financial statements or not. And in case this fact is not disclosed in the financial statements, the auditor would once again move forward to issue a modified report and express either a qualified opinion or an adverse opinion. And remember, the adverse opinion would only be issued if the matter is pervasive. And now that the report has been, or the opinion has been modified, it is so imperative to provide for the grounds of modification and basis for qualified opinion paragraph. And in case the auditor concludes that the disclosures provided in the financial statements are adequate, in such a scenario, he would move forward to issue an unmodified opinion. And by this time, there is an addition. The auditor would also include an emphasis of matter paragraph section, which would draw attention to the alternative basis of accounting and the reason for its use, so that the shareholders and the stakeholders and the users of the audit report are being able to see that the auditor has specifically emphasized on a point where, and at the same time, not modifying his opinion. We would now be moving finally towards the last situation provided in ISA 570, which describes a situation that management is unwilling to make or extend a going concern assessment. In such a scenario, the standard provides that the auditor would move forward to provide a modified report, expressing either a qualified opinion or a disclaimer. And remember, this disclaimer would only be provided if the matter is pervasive. And if it is a qualified opinion, then the grounds of modification would need to be provided. And same goes for the disclaimer. This ends our discussion on the implications of going concern issue on the audit report. And I think that this explanation is super easy, and the mind map will help you guys a great deal in acing your exams. Okay, now let's move forward to test yourself. Fine. So here's an activity that we people would be attempting to see if we have achieved the learning outcomes from this session. But before we attempt this activity, I would like to share some exam tips. So you will not be expected to draft an auditor's report in the AA exam, but you may be asked to present reasons for an unmodified or a modified opinion, or the inclusion of an emphasis of matter paragraph. You may also be required to identify and describe the elements of the auditor's report, and therefore candidates should ensure that they have a sound understanding of reporting implications developed through our previous slide. Additionally, you may also be presented with extracts from an auditor's report and be asked to critically appraise the extracts or challenge the proposed audit opinion. So let's attempt this audit activity to test our understanding of the various impacts of the going concern issue. So in these 6 scenarios, the examiner is asking us to suggest an appropriate audit opinion modification. And in case you do conclude that the auditor should provide a modification, then you must state the grounds for such modification. So the scenario number 1 is, based on the audit evidence obtained, no material uncertainty exists related to events or conditions that may cast significant doubt on the company's ability to continue as a going concern. So this is the very first scenario that we discussed on our mind map. In this case, the auditor would be issuing an unmodified opinion. And where there'd be an unmodified opinion, there would obviously be no grounds for modification. Scenario number 2, the going concern assumption is appropriate, but a material uncertainty exists that is adequately disclosed. Now that the disclosures are adequate, the auditor would move forward to issue an unmodified report. But this time, this would also be there with an addition of a paragraph titled Material Uncertainty Related to Going Concern. And this time as well, as the report has not been modified, there would be no grounds for modification. Number 3, as for 2, but the disclosures are inadequate. Now that the disclosures are inadequate, the report would be modified. The auditor would either be issuing a qualified except for opinion or an adverse opinion if the matter is pervasive. And the ground for modification would be material misstatement in regard to inadequate disclosures. 4, the going concern assumption is inappropriate, but the financial statements have been prepared on a going concern basis. As we have discussed earlier, this calls for an adverse opinion by the auditor. An adverse opinion means that the report has been modified, and because the opinion has been modified, the ground of modification is material misstatement. But this time, this is with regards to inappropriate basis of preparation of financial statements. Scenario 5. The going concern assumption is inappropriate and the financial statements have been prepared on alternative basis, which is adequately disclosed. Now that the disclosure is there and the auditor is concurring with the alternative basis, he would be issuing an unmodified opinion. But this would be accompanied by an emphasis of matter paragraph. And because of the fact that the opinion is not modified, there'd be no grounds of modification. Last scenario, management does not make a going concern assessment for at least 12 months from the end of the reporting period when requested by the auditor. So this is the situation number 3 that we just discussed on our mind mapping slide. So in this scenario, the auditor would either be issuing a qualified except for report or a disclaimer if the matter is pervasive. And as the opinion is modified, the grounds of modification would need to be provided, which is primarily the inability to collect evidence. It is hence a limitation imposed by the management. So let's quickly see the answers. The result of the activity will show how comfortable you are with the topic. And in case you got stuck, go back and revisit the mind map. This brings our entire session to an end. It was an interesting session. Thank you for being such a good audience.